Here is how to become a profitable futures trader, and in this video what we're going to be covering is the markets to trade, the futures point system, the exact strategy that I would use to become a profitable trader, as well as risk management and so much more. So if you guys do find value in this video, I would highly suggest subscribing to the channel. I have over 1100 videos teaching you guys on how to trade for completely free, and I go live every single morning and give you guys a completely free pre-market watch list as well as do live day trading. So make sure you guys are subscribed to the channel, but without further ado, let's hop into it. All right, so first I want to touch on the markets that I would personally trade. Now in the futures market, there's so many other futures that you could trade. You could trade gold futures, silver futures, platinum futures, corn futures, oil futures, and so much more. However, the top two most liquid ones and the most popular futures are going to be the S&P futures as well as the NASDAQ futures. Now, when trading the S&P futures, you have two different routes that you can go. You can trade the E-mini S&P futures, or you could trade the micro S&P futures. And we'll be talking about the difference between those two here in a little bit. But then also you could trade the E-mini NASDAQ futures or the micro NASDAQ futures. And again, we'll talk about the difference between the NASDAQ as well as the S&P. So the differences between the S&P and NASDAQ. The S&P is the top 500 companies in the US. However, they are diversified between tech, healthcare, banks, etc. So if you want to get an overall understanding of what's happening in the overall market, you would likely pull up the S&P. On the flip side, however, the NASDAQ is the top 100 companies by weight, but mostly these companies are going to be tech heavy, but do include a few other companies from other sectors. So typically, if you want to get an understanding of how tech is doing, you would pull up the NASDAQ futures. But then again, if you want to get a better understanding of the overall market, you would likely pull up the S&P futures. So now the differences between the minis and the micros. When trading futures, it runs off of the point system. So if you've ever traded options in the past, we have what is known as calls and puts. You buy calls when you think the price is going to go up. You buy puts when you think the price is going to go down. In futures, we do not have that. You're either long or you're short. If you think price is going to go up, you're going to be going long. If you think price is going to be going down, you're going to go short. And your profit loss depends on the point system. So if you decide to trade the E-mini S&P futures, 1 point is going to equate to $50. So let's say that price is trading at 4,000 on the S&P futures and you buy one long. Well, if price goes up to 4,001, you're going to make $50. If it goes up to 4,002, you're going to make $100. If it goes up to 4,010, you're going to make $500. Now that sounds amazing that you could catch a few points and make $150, but you also got to think on the flip side, if this were to go against you. So again, say you went long at 4,000, but price dropped all the way down to 39.97. Well, that's a loss of 3 points and you're going to lose $150. So there are two sides to that coin. So depending on what your risk tolerance is, if you have a larger bankroll, you could look at the E-mini S&P futures. However, what I think is going to be more realistic for most traders is going to be the micro S&P futures, where 1 point is going to equate to $5. So again, like the last scenario, if you went long at 4,000 and price went up to 40.10, that's a 10-point gain. You're going to make $50. If it only went up 1 point to 4,001, you would only make $5. Now on the flip side, if it went against you by, let's just say 2 points, you went long at 4,000, it dropped to 39.98, you're only going to lose $10. Now, another thing to keep in mind when choosing which futures you're going to trade is if you can only buy one E-mini contract, you can't really scale out of your position. You only get one buy and one sell, but you could buy 10 of the micros and scale out of your position as the trade moves in your favor. So theoretically, you could make more money trading the micros because you're able to scale out compared to the E-minis where you only get one buy and one sell. So that's the point system for the E-mini and micro S&P futures. As far as the E-mini NASDAQ futures, 1 point is going to equate to $20. Now, if you guys have ever looked at NASDAQ during market hours, it can move a whole lot of points very, very quick. Like one candle could be 30, 40, 50 points. So if you went long and price jumped 20 points, you're going to make $400 profit. But then also on the flip side, if it went against you 20 points, you can lose $400. And again, 20 points on NASDAQ can happen very, very quick. So if you're not experienced in the futures market, I highly suggest staying away from the NASDAQ futures, especially the E-minis where 1 point equates to $20. Now, if you're going to be trading the NASDAQ, I would personally look into the micros where 1 point is going to equal $2. Again, it's very easy for NASDAQ to do 20, 30, 40 point candles. So if you went long only one micro NASDAQ and called a 30-point candle, that's $60 profit. And again, it can happen very quick. And then the same goes as far as the E-mini and micro NASDAQ futures. You could buy more of the micros compared to the E-minis. So the E-mini, you're likely only going to get one entry and one sell, but the micros, you could buy multiple contracts, scale out of your position, and catch a larger move. So again, if you are new to trading futures, I highly suggest starting with the micros. And honestly, I know a lot of profitable futures traders that only trade the micros for that one sole reason that they can scale out of more of their position and they're more consistent when trading the micros. So as you'll see right here, I even say it again, my honest advice, start with the micros. And again, honestly, you could just continue to trade the micros if that's where you're consistent and you don't like the whole 1 point equals $50 or 1 point equals $20. Now, when trading futures, the strategy that I would personally use is focusing on higher time frame key levels. So the way that I find my key levels are through supply and demand, Fibonacci, support and resistance, and then there's a couple different ways that I will find these key levels. So what I'll do is I'll mark the higher time frame levels and then I'll simply break it down to a smaller time frame to snipe my entries. So typically when I'm finding my higher time frame key levels, I start on the weekly, break it down to a daily, 4 hour, 2 hour, 1 hour. And then it's very rare that I'll drop it down any lower than that 1 hour to find a key level. Now, when price is approaching these key levels on the higher time frame, I'll then break it down to a 5-minute, 15-minute, and 2-minute time frame to snipe a better entry. And if you do want to learn more about how I identify these key levels as well as intraday trading setups that I look for, I do have 2 books on Amazon. The first one, The New Age of Technical Analysis, 450 pages. The second one, The New Age of Day Trading, 320 pages, for a combined page count of 770 pages. So if you guys do want to check that out, that link is going to be down in the description. Now, as far as risk management, what you guys need to understand is every trade's risk will be different. One trade you could be willing to risk 3 points on the S&P. Another trade you could be risking 6. Another trade you could be risking 12. It all depends on when did you get your entry. The later your entry, the larger your risk is going to be. The earlier your entry, the smaller your risk is going to be. And that's why I always stress sniper entries, because you're always going to skew the risk to reward in your favor. So again, keep in mind, every trade's risk will be different. So before choosing your position size, you must first calculate your risk. And again, I'll show you guys here in a second how I identify my risk, but you got to determine, okay, am I risking 5 points, 6 points, 7 points? And once you calculate that, then you can choose your position size. Because let's just say that you are trading the S&P 500 futures, the E-minis, and you're risking 4 points. Well, that's $200. If you can only risk $200, then you can only buy one E-mini. However, if you're only risking 2 points, you could buy 2 E-minis and be risking the same amount. So again, it all depends on when you enter your trade and what is your risk. Then from there, you can choose your position size. So let me show you how I identify my risk. Now, looking at the NASDAQ futures, I have this 4-hour demand level down here at 19,526. Now, how did I identify this level? Well, if we go to the 4-hour time frame, we have our red basing candle here, large aggressive move up. This should become a demand area. Typically, when trading supply and demand, I will watch the very beginning of the zone for an entry. Breaking it down to a smaller time frame, the 2-minute time frame, you can see that price dropped all the way down into the demand, just short of it by a couple points, rebounded it, very strong volume right off of that level. This candle right here confirmed a long entry with a stop loss right below this low. So if you went long at the end of this candle, you were risking about 25 points, give or take. So then from there, you could calculate, okay, well, am I only comfortable with losing 25 points total, 50 points total, 75 points total? So once you determine how many points you're willing to lose total, then from there, you can say, okay, I'm buying 1 NQ, 2 NQ, 3 NQ, etc. Now, had you waited for a higher time frame close, let's try the 15-minute. Yeah, the 15-minute. Your entry would have been all the way up here at 19,585. So now you're risking about 60 points for a stop loss right below this wick. So you can see how using sniper entries, you went from a 25 point potential loss to a potential loss of 60 points. So your entry really matters when getting into a trade. And then from there, you can calculate, okay, I can buy this many contracts. Or a trade that I ended up taking last week. So if we zoom out to the 4-hour time frame, there was this huge supply zone right here on the NASDAQ futures. It started at 18,954. Well, we break it down to a 5-minute time frame and we go back to the day when we first tested it, which was Monday. You can see that as price came up into the level, we rejected it. Nice upper wick, elevation of volume. We had a lot of sellers on Bookmap. So as a result, I sniped it on a smaller time frame, the 2 minutes, somewhere like up in this area right here. And my stop loss was literally right above this high point right here, and I caught this entire move down. So the way that I determine what my actual stop loss is what I call the entry candle. And the entry candle is the candle that comes to our key level and confirms the trade. So again, going back to today, this was your entry candle to go long. This was the candle that confirmed. Therefore, your stop loss is on the opposite side of the entry candle. Going back to that same example that I showed you as far as the supply. When price came up into the supply zone and confirmed it with a reject, this was your entry candle. This was the candle that confirmed to go short. Therefore, my stop loss is right above the high of the entry candle. Or a trade that I took on Thursday. This was also based off of a 2-minute time frame. So I was watching a higher time frame key level, and I believe it was an hourly 21 EMA. As price came down towards that hourly 21 EMA and reclaimed it with this nice bullish candlestick right here, again, elevation of volume, I ended up going long with my stop loss right below this low. So again, this was the candle that confirmed the trade. This is my entry candle. My stop loss is on the opposite side of that entry candle. Now, had I waited for a higher time frame close, heading back on over to Thursday, you can see that that 2-minute candle gave us the best possible entry, because had we waited for that 5-minute candle close, then our risk is way, way higher than it originally was. So to summarize the risk management, your stop loss is on the opposite side of the entry candle. Again, the entry candle is the candle that confirms the trade, saying, hey, get in. But depending on the time frame, your stop loss could be smaller or it could be larger. And then from there, you have to calculate your risk, and then you can determine what your position size is. But anyways, that's going to wrap up this video on how to become a profitable futures trader. If you guys did find value, make sure to smash that like button as well as clicking that subscribe and that bell icon. It would mean the absolute world to me. And again, make sure you guys check out some of the 1,100 free videos that I have on my channel. Other than that, everybody have an amazing rest of your day, and I'll see you guys in the next video.